What are some tax strategies if you plan to immigrate to the United States? First off, welcome to America, the home of baseball, apple pie, and the IRS. And there are a few strategies once you do become a green card holder or an immigrant, whether it's L1, O1, etc. The thing is, all these strategies need to be done before you step foot and you're a U.S. tax resident. I'm Vincenzo Villamena, CPA and founder of Global Expat Advisors. We have helped hundreds of people with their tax planning as they immigrate to the United States, as well as doing all the compliance once they're a U.S. tax resident. So let's get into it. If you are a green card holder, you are essentially the same as a U.S. citizen. A lot of times, if you get your green card abroad, the day that you fly into the United States, that is your first day of being a U.S. tax resident, so everything needs to be done before that day. There are other ways to be a U.S. tax resident, predominantly by failing the substantial presence test or being substantially present in the United States. And what that means is there's a test over a 3-year period. Essentially it equals around 120 days per year. Candidly, it's a little more complicated than that. But if you are over 3 years, constantly come to the United States, constantly over basically the 120-day mark, you will be a U.S. tax resident. There is a way to get out of that residency by claiming the closer connection test. However, closer connection no longer works if you're 183 days in the United States. And then the only way is if you are from a treaty country, there is something called the tax treaty tiebreaker, which would apply in that case. So what are some strategies for immigrating to the United States? The best strategy that we implement is something called a check the box selection. It allows for a step up in the cost basis of whether it's real estate or a stock, anything where you have unrealized gains before you move to the United States. The easiest way to just do it is to just sell the stock before you move. Then you could realize the gains as a non-US tax resident and be done with it. However, that might potentially cause tax implications in your home country. And so there's another way to do it. Let's do an example. Okay, let's see you got stock, you bought it for $300,000 years ago, before you became a U.S. tax resident, etc. Now you're planning on moving to the United States, become a U.S. tax resident, and that stock is now worth $800,000. Okay, you do this check the box selection, you put it in a company, you check the box, and that cost basis steps up to $800K as of the day that you become a U.S. tax resident, the day you fly to the United States and become that tax resident. Then a year down the line, let's say, you sell it for $1 million. Okay, you've held it for a year as a U.S. tax resident, you sell it for $1 million. Okay, what are the implications? Let's say you didn't contact us, didn't talk to anyone, you did no tax planning. What would happen? Then under that case, you would have to pay the full capital gain on the stock. Okay, in this case, the $1 million proceeds minus the $300,000 which you bought while you were not a U.S. tax resident, while you had nothing to do with the States. And in this case, you would have a $700,000 capital gain, which would be taxable at 23.8%. You would have to pay $166,000 in tax. However, of course, you didn't go that route. You reached out to Global Expat Advisors, you did the appropriate tax planning, and in this case, your cost basis is $800,000, which is the value of the stock the day you moved to the United States. So if you sold it for $1 million after getting the step up in basis of $800,000, that means that your capital gain is only $200,000. Your tax rate would be lower, it'd be 15%, and you would only pay $30,000 in capital gains tax. So for those that are not mathematicians, what does that mean? You either didn't do the tax planning and you had to pay $166,000, or you did the tax planning and you did $30,000 of tax, which means you had a $136 savings. This is a great example of what we do with people, and this contributes substantial savings. Now let's go into a few other tax saving strategies for people that immigrate to the United States. Okay, again, check the box selection, what we just did, the most important strategy if you have appreciated assets that have unrealized gains, again, before you move to the United States. Number 2, if you have foreign mutual funds, again, investments, it could be real estate investments, etc., owned by foreign companies, so on, then they could be considered PFICs, which stands for passive foreign investment companies. So what is the best way to do with a PFIC? To sell them before you become a US tax resident. Again, any type of foreign mutual fund could be deemed a PFIC, and it's important that you sell. Again, another one would be analyzing your life insurance. Again, life insurance could be deemed PFICs, passive foreign investment companies, and can potentially have negative tax consequences as a US tax resident. Same thing goes for even foreign mutual funds that your foreign pension owns, so on. So again, really important to do the full analysis for people that are immigrating to the United States. And then finally, if you are ownership in a non-US company, it could be a family business, etc. It's really important because there could be potential GILTI tax implications. Even though it's a company outside the United States, once you become a US tax resident, if you're a majority owner, part owner, etc., there are implications of owning that. And you should do the appropriate steps, potentially switch it in the name of a family member, sell it, so on. And so really, it's super important to do all this stuff before you become a US tax resident. Okay? Allow yourself some time, save yourself some stress, and do smart tax planning. I'm Vincenzo Villamena at Global Expat Advisors. So if you need any help with your immigration tax planning, reach out to us for a consultation. We're happy to help you analyze it and show you how you can save taxes before you move.